Welcome to our deep dive into the climate change scam, how big money is exploiting the crisis for profit. In this video, we unravel the complex web of financial interests behind the climate agenda, exposing how corporations and wealthy entities profit from what is often marketed as environmental progress. We will cover everything from carbon credits and emissions trading to the growing monopoly on renewable energy solutions, and how greenwashing tactics manipulate public perception. Join us as we investigate the nuances of climate finance, government subsidies, and the alarming implications of a future driven by elite agendas and digital control. 1. How big money is profiting from the climate agenda? The narrative of climate change is not just about saving the planet. It is also about navigating a financial landscape where big money stands to make substantial gains. Companies and investors are finding ways to turn climate-related initiatives into profit-making ventures. From carbon credits to government subsidies, the climate agenda is rife with opportunities for financial gain. As climate change becomes a focal point for global policy, the economic consequences are far-reaching, affecting everything from stock markets to consumer behavior. The question remains: who truly benefits from these initiatives, and at what cost to our planet? 2. Carbon credits and emissions trading. The carbon credit market, valued at billions, allows corporations to offset their emissions by purchasing credits rather than making real reductions, creating a lucrative financial scheme. This system enables companies to continue polluting while paying for their environmental impact in a financial sense. The concept of emissions trading gives businesses a way to appear environmentally conscious without having to implement genuine changes in their operations. Critics argue that this system is more about financial gain than environmental protection, as it allows big polluters to buy their way out of responsibility. This raises questions about the effectiveness of such schemes in truly reducing global carbon emissions. 3. Greenwashing by corporations. Many major companies market themselves as eco-friendly, while continuing unsustainable practices. From airlines offering carbon offsets to oil companies branding themselves as green, these efforts often prioritize image over impact. This phenomenon, known as greenwashing, involves misleading consumers into believing that a company is doing more for the environment than it actually is. For example, a company might advertise its commitment to using recycled materials, while neglecting to mention its significant carbon footprint. Greenwashing allows companies to capitalize on the growing demand for sustainable products without making meaningful changes to their business practices. 4. Government subsidies and tax breaks. Renewable energy companies and electric vehicle manufacturers receive massive government funding, often benefiting a few elite investors rather than driving real change. These subsidies and tax breaks are intended to encourage the development of green technologies, but they can also lead to market distortions. In some cases, companies may prioritize projects that secure the most government funding, rather than those that offer the greatest environmental benefits. This can result in a concentration of wealth and power among a small group of investors, while the broader public sees little benefit from government spending. 5. The electric vehicle, EV, illusion. EVs are marketed as a clean alternative to gas-powered cars, but their production requires extensive mining of rare earth minerals, causing environmental destruction and exploitation in countries like the Congo. While electric vehicles emit less CO2 during operation, their production process can have significant environmental and social impacts. The mining required to obtain the necessary materials for EV batteries often takes place in countries with weak labor and environmental protections. This raises ethical questions about the true cost of electric vehicles and whether they represent a sustainable solution to climate change. 6. The renewable energy monopoly. Wind and solar power projects often require vast amounts of land and resources, while being controlled by major corporations that push out smaller competitors and traditional energy sectors. This dominance can stifle innovation and limit the diversity of energy sources available to consumers. Large corporations often have the resources to secure prime locations for renewable energy projects, leaving smaller companies struggling to compete. This concentration of power can lead to a lack of competition and higher prices for renewable energy, ultimately benefiting the bottom line of big corporations rather than the environment. 7. Climate finance and green bonds. Trillions are being funneled into green bonds and climate funds, often controlled by major banks and investment firms that dictate how climate money is spent, prioritizing financial returns over environmental impact. These financial instruments are designed to fund projects that have positive environmental outcomes, but they can also serve as vehicles for profit. The control exerted by large financial institutions over these funds can lead to decisions that prioritize financial gains over genuine environmental improvements. This raises concerns about the true effectiveness of climate finance in addressing the challenges posed by climate change. 8. Media and fear-based marketing. Constant climate crisis narratives drive consumer spending toward sustainable products, often marked up in price without significant ecological benefits. The media plays a crucial role in shaping public perception of climate change, often using fear-based tactics to encourage consumer behavior. This can lead to increased demand for products labeled as sustainable, even if their environmental benefits are minimal. The result is a market where companies can charge premium prices for products that offer little in terms of real environmental impact, capitalizing on consumers' desire to do their part for the planet. 9. Elitist climate conferences. Billionaire investors, politicians, and business leaders attend climate summits in private jets, advocating for policies that increase corporate profits while imposing restrictions on everyday people. These high-profile events often focus on policy discussions that prioritize economic growth over environmental sustainability. The irony of advocating for climate action while contributing to emissions through private air travel is not lost on critics. These conferences can create an image of progress and commitment, but they often result in policies that benefit the wealthy at the expense of the broader population. 10. The push for digital control. Carbon tracking apps, personal carbon allowances, and ESG, environmental, social, governance, scores could lead to increased surveillance and control over consumer choices, benefiting corporations and financial institutions. As technology becomes more integrated into daily life, there is a growing trend toward using digital tools to monitor and manage individual carbon footprints. While these tools have the potential to promote sustainable behavior, they also raise concerns about privacy and control. The data collected through these systems can be used by companies and financial institutions to influence consumer behavior and maximize profits, often without clear benefits to the environment. 11. Job displacement and economic disruption. Climate policies often destroy traditional jobs in coal, oil, and gas while creating profit-driven tech and automation industries that benefit the elite. The transition to a green economy can lead to significant economic disruption, particularly in regions that rely heavily on fossil fuel industries. While new jobs may be created in renewable energy and technology sectors, they are not always accessible to those who have lost their livelihoods in traditional industries. This can lead to increased inequality and social unrest, as the benefits of climate policies are unevenly distributed across society.